Hello, Velocity Banking students, Kingdom citizens. How we doing today? As you can see, we're a little late on time. Forgive me. I forgot. We had a little lighting issues. We're still learning. All right? So bear with me. We're starting. Today we're going to be doing a Velocity Banking scenario. I'm super excited. Let me know who's in the house. Okay? Let me know who's here. Comment below. Give me some of your thoughts. And I'm actually gonna, look over here. I got my other laptop to kind of help me along the way and see what's going on. All right, so before we get started, I just want to give some people time to tune in. I did say we was gonna start at 12 o'clock Eastern time, but as you can see, we're a little delayed, but that's all right. That's all right. Let me know who's here, who's in the house, big guy. Got Josh in the background. I got my friend Christina here helping me out, making another successful Velocity Banking scenario so that you guys can learn this stuff. All right, we gotta get our finances in order. We gotta start speeding up our pace on which we pay off debt. Who's in the house?
So Mr. Joel Flores is here. He said, "Hey." Albert Ramirez, "How are you doing, Mr. D?" Lil Netta said, "Hi."
All right, Mr. Flores and
Afia Moore, Afia.
Yes, I know.
Miss Haua in the house.
Oh, that's my Hawaiian lady.
Okay. Rochelle Smith.
Rochelle, how are you?
Travis Clegg.
Hey,
Corey
Travis.
Morrow.
These are all clients. I love it.
Allison said, "Ooh, crisp shirt." Xavier, good morning. Renard, David, Shalonda, Javinci.
Shalonda, hello.
Javinci from Port St. Lucie is here.
Yes, cool. Nice. How many people we got?
15.
All right, it's gonna boost up any minute. Let's see as soon as we go live. I'm trying to get it on my laptop here, but I can't see it. I wanted to be able to see what's going on. So we're gonna get into this. All right. So today we're gonna be doing a Velocity Banking scenario. I have a client here on the board. This is a gentleman that has a home equity line of credit, which is in the first position. Okay, we have a first position HELOC here. The primary goal is to pay off as much debt as we possibly can by leveraging this debt tool. Okay, overall he has over $300,000 of debt. Current income is $6,200. This is his personal income. This is a gentleman that does real estate investing, so he has real estate income. I did not include that because that money goes into a business checking account. So the cash flow from that side of the business, we're actually gonna separate it. So when I'm working with clients, whether we're doing Velocity Banking on the business side or the personal, typically I separate it unless you have all your money going to the personal account or all your money going to a business. Then it's just, one house. In this case, $6,200 is on the personal side of his income. His current expenses to date, all right, so we're in September 2019, like the last week of the month, right? It's September 24th. Been talking to this gentleman for about a month or so now, and he's getting ready to implement the concept. We got all our numbers down, all right? Here's his current cash flow. These are conservative numbers that I'm using in terms of the cash flow. We went ahead and overestimated on expenses, underestimated on cash flow, so $1,500. I also am overestimating the balance on his HELOC because when you have a HELOC and the interest, it fluctuates from time to time as you go through the month. When you're making payments on it, it's going to go up and it's going to go down. So we're starting off as if we're in October. All right, so that's how I'm going to start this off. I was communicating with him in September, and we're still in September, but this is what the balance would look like if we did nothing until we actually started in October. So $163,543.46 is the current balance owed on this first position HELOC, and it's $164,000. So it's basically maxed out. It's only like $1,000 in available credit. Interest rate's 5%. This HELOC is a principal and interest payments. It's not an interest only, it's principal and interest. It's revolving, simple interest. Okay, it meets all the criterias, unlimited transactions, no issues there in terms of the debt tool. So it meets the criteria for velocity banking. I want to direct our attention over here, and I'm going to show you some things that are going on in this particular scenario that I'm going to go ahead and take advantage of to expedite the speed at which I pay off debt, right? So some things to know is, first and foremost, he's got a fix and flip going on, I believe. So at the end of October, he's looking to profit about $27,000. All right. So we've got this about number, $27,000 in profit cash that we can put somewhere, right? And I'm going to give some options on what we can do with that money in terms of paying off debt. His goal is to become debt free, so that's what we're focusing on. Another thing to know is we have a Chase credit card. The balance on it as of right now is $1,216.07. We have a 0% offer. So we've got two debt tools now. We've got the HELOC, and now we've got a Chase credit card. 0% till September 2020, right? So I have about, what, 11, that's a whole year, okay? Here's what we're gonna do to take advantage of this is we're gonna shift expenses to this credit card so that I can temporarily increase my cash flow over here so that I can direct all my cash flow to the HELOC and reduce my interest costs. All right? So what we're going to do here is I got an estimate of certain bills that he has that we could either pay for by the year or just pay them monthly, running them through this 0% credit card for just a short period of time, all right, so that we can have more money go to the HELOC. So in this case, $145 for the insurance monthly. We're going to pay that for the whole entire year. He's got $180, I believe, towards like utilities. Either he can pay it quarterly, I forgot, or if it's just monthly. So that's going to be a monthly expense he's running through the credit card. We've got a marching band expense, $445. So this is a one-time payment to pay off that expense, and my cash flow is going to go up $100. So we're going to add $100 to the $1,517. All right. And then the last two things, estimate is a cell phone bill and then like gas or food, miscellaneous, things like that. All I want to do over the next 5 months from October to about February 2020 is I want to run whatever bills I possibly can through that credit card up to $10,000. That's it. Just up to $10K. Meanwhile, I'm going to be paying the minimum monthly payment on that credit card. That's it. So that's how we're going to be using the credit card here, shifting the expenses. When I do this, right, when I shift the expenses, it's not coming out of my income no more. So I'm going to be making my $6,200 each and every month. And now my expenses are no longer this number. Okay? My expenses from here drop somewhere a little over $800 a month. Okay, that I'm going to have redirected in cash flow. The total number that I wrote in my notes was, let's see, $2,342.16 from 1517 that I'm going to be able to work with. All right, very powerful. So I got more cash flow, less expenses. That means when I start dumping all my income, right, because that's what we're doing here. We're going to be dumping all my income into his first position HELOC. Once I do that, now in terms of expenses coming out to pay my bills for the month, right, and this is where people get confused all the time. They're like, all right, Denzel, you want me to put all my money in, and then how do I pay my bills, right? People get confused with that all the time. Look, it's a simple transfer. Okay, this HELOC is attached to a checking account at his bank, so he's simply going to transfer money the same day that I put money in. So whether you're someone that gets paid monthly, weekly, bi-weekly, whatever it is, you're able to see, okay, if I get paid weekly, that means 4 times a month, money's going into the line of credit. In terms of money coming out of your line of credit, what I usually do is I look either from like paycheck to paycheck, or I might do every 3 to 5 days. The purpose behind that is I simply want to limit the amount of money that we're pulling out at once so that I could have more money sitting in this HELOC, lowering my interest rate. I mean, lowering my interest cost. So the 5%, I believe as of right now, his mortgage payment is around $1,400 a month. And of that $1,400, about $600+ going towards interest, right? Each and every month with the HELOC. So to reduce that, we're actually going to be doing velocity banking on the debt tool. Why? Because we need to create space so that we can actually chunk at something, at his other debts, because we've got other debts on the table here. So the month of September, I'm not even going to count it. I'm going to let that be space, growth, I should say. So I'm going to underestimate the actual results over the next 5 months, right? And then we're going to see what this would actually look like in terms of the balance, what it's going to look like in about 5 months. So starting in October, income goes in. Sheesh, it's supposed to be $6,200. Look at that, making mistakes already. I think I'm nervous because of the new space and whatnot, But we're good here. So my expenses are now going to be $3,800. Let's see, $3,857. That's what I wrote. This is an overestimate. He could potentially run other bills through here, through the credit card, up to $10K. Why $10K? It's, just 50%. I don't really want to go more than that. I don't want to go too much in debt on the credit card. I don't want to be overutilizing my credit space, so to speak. I just simply want to shift a couple of stuff, get my cash flow up. All right. So let's do some numbers here. Let's check this out. Now, what I'm not doing is I'm not factoring the interest costs, right? Because here's what's happening. The income, the $6,200 that goes in, right? Everything goes in. The expenses, this $3,857 is also including the actual the mortgage payment itself, right? I didn't include it here on purpose, just to have this this space, so to speak. I just want to analyze the cash flow and the expenses that's coming out and going in. When you start dumping all your income into your debt tool, especially like a HELOC, a first position HELOC, understand that that following month, the payment is going to drastically lower. Your interest cost is going to lower. And now even less money is coming out. So I've got this initial overall expenses that I was working with. We shifted a bunch of bills to the credit card, increased our cash flow, and now I'm basically removing the payment itself on the HELOC. I don't really have a payment now because this $6,200 is the payment each and every month that's going into the HELOC. So if that's the payment, that means more money is going towards the principal balance on the mortgage, okay? So let's take a look. If I got 163, 543, 46, minus the 6,200, balance goes down to 157, expenses come out, 3,857, not all at once, over time, throughout the month, expenses coming out, right? Balance is at 161, okay? That's at the end of October, right? So from the beginning to the end, boom. So the expenses dropped by basically the cash flow, the new cash flow that I have, which is the 2342.16, all right? And we're going to do it again. Expenses, income goes in, expenses come out, all right? 158. Okay, this is now October, end of November. Let's do it again. Income goes in, expenses come out. This is the concept, people. This is it. All I'm doing is having all of my cash flow show up as principal. And because all this income's going in each and every month, it's drastically lowering my interest on the monthly payment itself. What's cool about the HELOC, unlike a regular traditional mortgage, is when I'm chunking into a traditional mortgage, the payment stays the same. Payment stays the same. Well, with the HELOC, the payment will change. And if the payment's changing, less interest, right? Same thing with the traditional mortgage as well, but the other major difference is that interest is amortized, whereas this interest is calculated daily, okay? So end of December, I'm at 156. Going into January, income goes in, expenses come out. We're looking good. All right, so that's January. Income goes in, expenses come out. Now we're at 151 February. So by February 2020, mind you, this is not including, I didn't include the actual mortgage, the HELOC payment itself, because that whole payment is staying in the HELOC, which is bringing the balance down as well. So that whole thing is staying in there. I'm just showing you what the income going in and then the other expenses coming out. So 151 is about what it looks like. This is enough room for me to make my next move in terms of what I want to chunk at. Now, mind you, I got a credit card over here at 0%, right? So that's sitting there. I'm just paying the minimum on that. I'm getting cashback rewards by swiping the card. So I still have plenty of time before that interest rate expires, all right? So in terms of this gentleman here, we have a couple of things. We have a couple of debts. We've got a couple of different credit cards that I want to wipe out come February 2020, right? So worst case scenario, this is what the balance is going to look like come February 2020. Now, if I went ahead and assumed what the mortgage payment would look like throughout these 5 months, because it's going to be like changing for him. So I'm going to overestimate and say it's a 1,400, because his last statement that he sent me was 1,533.96 was his mortgage payment, and about $600 plus of that went towards interest. It's a 5% first position HELOC. Okay, so if I shifted about $900 of expenses there, and then in terms of expenses coming out, the number is now, I have to minus 38. My mom's texting me. She's like, love the shirt. Love you too, Mom. Love you too. Look what we're doing here. It's amazing looking at your son doing all this stuff. Isn't this so cool? God bless, right? Just, giving gifts. So 3857 minus the mortgage payment. So in reality, what's actually coming out of the HELOC, and this is what I was doing with my client. I was showing him each and everything that's coming out of the HELOC each and every month. What's actually coming out is $2,457, about, maybe a little more, could be a little less, but on average, instead of my expenses being $3,857 coming out of the HELOC, right? Because you still have the expense of the monthly HELOC payment, but it's getting satisfied each and every month when you dump the income in. So that money is being used twice. Same money. Income pays the HELOC, which pays the payment, and then I turn around and use that same money to take my other living expenses, debt payments out to keep going, and then 100% of my cash flow becomes principal. Unlike if I was to, if I was to do debt snowball, I make $6,200, my leftover is $1,517. Out of my $4,682, you got the mortgage payment, right? So you pay the mortgage. If you're going to do debt snowball, you're just paying it. And then at the end of the month, you make an extra payment of $1,517. Doing it that way, not all of this is going to go towards principal. It'll be an extra payment, right? But depending on how your mortgage payment is set up, hey, they might hold that payment, number one. They might roll it over to the following month, or it might just be, it'll be a portion of that money is going towards principal and interest. And then in terms of the interest that you pay off on the back end of that mortgage, in terms of like, you start off with a 30-year or 25, 35-year, whatever your initial timeline was. When you're just making extra payments per month, you're not exactly doing a whole lot of damage on the back end. You are doing damage, no doubt. Problem is the money goes away, it disappears. You can't use it again, right, as effectively. But if I'm dumping all your income in, all of that money is now, you're like doing the math all over again. The company has to recalculate the math each and every time, and then calculate your new interest, and then shave a bunch of interest off the back end. Sounds confusing. I'm confusing myself, but this stuff is really, really cool when you start, when you really start like putting the pieces together. You're like, okay, I think I can do this. All right. So if my expenses are $2,457, that's coming out of the HELOC. That means more money is staying in, right? I'm going to restart the numbers again as if I was in October, even though we're in September right now, acting as if I'm in October. New income going in, expenses now coming out, 2,457. Now that balance originally was, I think of the numbers before was like 160 something. Now we're at 159, right? And then if you're wondering about, oh, Denzel, well, how does the, you're not calculating the interest. The only reason why I'm not calculating the interest is because I created that space already. I already created the space. So whatever numbers I get, when I get to February 2020, when I'm ready to make that next chunk, I'm already factoring in whatever the cost is going to be. So whatever the number I get to, it's going to be higher than what the actual result is when my client actually starts doing it. Okay? So 159, 800, right? And here's how I get my range. I'm factoring in unexpected expenses, emergencies, the kid's birthday, wife's birthday, Christmas. All that is being factored in when I'm running your numbers, when we work together one-on-one. That's another, thing that I think a lot of people, ask is, hey, what, I dump all my income in, and then what do I do when I want to, go out, or when I want to go on vacation or something? I'm like, I got you, Papo, I got you. We figure this out together. Okay, so income goes in. This is end of October. That's what, 30-day window. Okay, 159, let me just redo that again. 159, 800 minus 62. Income, expenses coming out, 156. Okay, do it again. 152. Look how much faster I'm going. This is when your whole payment becomes like basically principal. And my interest cost drops dramatically. Okay, 148. So that's November, December, January. By the end of February or sooner, my balance on the HELOC should be anywhere from 144K to about 150K. Okay, so that's my range. With that range, now I can do some damage. Okay, I'm gonna look at his other debts here. Here's what we got. We have a Venture Capital One credit card, originally in September, owed $7,000. We got a Flagstar credit card. We got another Fifth Third Bank, we got Wells Fargo, American Express, bunch of different credit cards, right? Now, let me see something here. I want to make sure I get my numbers right so I don't confuse you guys, right? So when I approach February 2020, whatever the balance is going to be somewhere around 144 to 150K. That's enough available credit from 164 for me to make a move, okay? I want to increase cash flow. My primary objective is I want to send all my money to the income. I want to pay off all the other little debts that he has and then work on the big guy later, right? So I don't mind paying the interest over here to save interest on credit cards that are charging me like 20+%. What velocity banking is somewhat doing is like debt consolidation, but in a more effective way in terms of how you pay things. All I'm doing is shifting how you pay your bills, okay? So we've got, what we're gonna do February 2020 for this gentleman is we're gonna pay off venture capital, Key Bank, Fifth Third Bank, and Wells Fargo for a positive cash flow gain of 534, okay, on top of the 1617 cash flow. That's the true cash flow. This is shifted cash flow, right? So these things are bills that he's gonna keep paying even after he's debt free. So all I'm doing from now to September 20 is just holding off. I'm not exactly gonna pay it off yet. When I do go to pay it off, I'm gonna have plenty of money to do so because it was expenses, money that was already coming out anyways. All I did was defer the payments out a little bit so I could have more money coming here, okay? So that's all I wanna do, okay? That's all I wanna do there. So by February 2020, I pay off 4 debts. From October to February, I wiped out, I don't know, do the math, 163 from anywhere from 144 to 150, right? And then in terms of what we wipe out on the leveraged, on the other credit card debts, that's another good, I want to say, 10+ thousand. 10+ thousand? Not bad at all. Okay? So this is what I like to do all day long. Just wanted to show you guys, give you guys an idea of what we're going to be doing on my Velocity Banking Masterclass coming up November. All I'm going to do is a bunch of live streams, private, for all the people that signed up. If you haven't signed up, you haven't enrolled yet, get yourself together, figure out your finances, let's make a move so that you can invest in yourself, start doing velocity banking. Work with me. I'm gonna put your numbers on the board, get to ask me any questions you like before we get this thing started. So what I wanna do now is I wanna shift into some Q&A. So whoever's in the house, if you're new or if you're an existing client, and it's been a while since we last spoke, and you have a question, anything you want to cover, any questions that you have, I'm going to have my friend Josh read them out to me, and we'll get this show on the road. Let me know their name so I can give them a shout out. And start from the top. Start from the, like, see who put in questions early.
I see like one question.
One question so far? What do you say?
They said if we have no debt, can we skip and go straight to IB? Suzanne Johnson.
IBC?
He just says IB.
IB, she's probably saying infinite banking. The answer is yes. So the question was, class, if I'm already debt-free, right? Got no freaking debt. And I've got, you know, income, got my expenses, I got decent cash flow. Maybe I have a debt tool that I might want to use for the infinite banking concept. The answer is yes. There's no need to do velocity banking if I don't have any debt and I'm not investing in anything. Okay, so if I don't have debt, I'm debt free, and I'm not investing, velocity banking is sort of like on idle. It would not make sense to just do velocity banking in terms of paying bills unless you're using a credit card. But even then, you're not increasing cash flow when you do that. What you're doing is you're getting cash back rewards and you're building your credit. So maybe there's like a little income gain from that by getting cash back rewards and things like that. But in that scenario, yes. So we can skip velocity banking, go right to IBC, start our high cash value life insurance policy, get that show on the road. And here's how I determine your numbers. Okay, here's one way that we can set up this type of account. And for those that are new and you don't know what the infinite banking concept is, in a nutshell, it's what we do with velocity banking. But at the same time, we're actually creating wealth using life insurance. Specifically on this channel and other channels that teach IBC, typically we use whole life policies rather than IUL. So if you're ever talking to an IBC agent, majority of the time they're going to show you a whole life policy. Typically you want to go with the 4 major mutual life insurance companies. You want to look at how much money is going towards premium, okay, and how much is going towards cash. All right. In a nutshell, any policy you look at, you want anywhere from 10 to 25% going towards premium of however much money you put in. And then you want anywhere from 75% to 90% going towards cash. Most of my clients that I work with, I stick with the 90 because it just makes sense based on how I like to structure the accounts. So what I do typically is if I was going to establish my own private bank or my own family bank, whatever the different terminologies that people are using, what I do is I look at your expenses, I look at your cash flow, and I see, okay, how much bills can I pay annually, like right up front? And if I have a line of credit or some sort of debt tool that I can stuff a capital amount of money, you know, like a large sum of money, an initial capital, into the policy, whatever that number is, right? We want majority going towards cash, very little towards premium. As soon as that occurs, what I'm doing, instead of using your cash flow to cover this cost of insurance, what I'm actually doing is I'm taking your cash flow, timesing it by 12 for the whole year to get a nice little estimate, see where we're at. Let's say for you it's $20,000 a year you have in excess cash flow. Okay, great. So you got that 20K. But what I actually want to do is look at your expenses, right? And see how much expenses could I run through here to increase that capital. Also, if you're an individual that does have debt, I'm going to look at your debts and see what debts could I shift there. So before I make a chunk towards a debt from a line of credit, if I'm doing velocity banking, if there's enough cash flow, good income, initial capital to work with, what I like to do is send the money to you first, then I borrow against it to pay off debt. IBC ends up being better than velocity banking in a lot of cases that I work with, from what I've been noticing, because you're creating your own line of credit here that doesn't require a credit check. You don't have to worry about utilization or anything like that. Okay? So, next question. That was pretty in-depth. I love talking about IBC because I'm learning more and more about it. I'm learning about the red flags and what to be aware of, and who to work with, who to trust, because that stuff is not easily comprehended right away. It took me like a whole year to get it. And now I have 2 policies, one with Mass, one with Guardian, and I'm just sending money to it, which then I borrow against to fund my business, to get things like this. Not bad, right? What's the next question?
Matthew Gavin wants to know, how does he enroll into the Velocity Banking Manifesto?
Velocity Banking Manifesto, that's on my website, denzelrodriguez.com, or you can look in the link below in the description. There's it'll say Velocity Banking Manifesto. You can sign up. That's where I noticed over the past year now, what I got almost 300 Velocity Banking videos, right? And infinite banking videos all together. So what I'm doing is putting videos in order, and then the videos that I starting to produce and create, I structure them in order, create little series. And it's a great starting point because I get a lot of questions. They're like, okay, yo, where do I start when it comes to Velocity Banking? And so I created this very, very affordable video layout program to pretty much answer all the questions. So by the time you and I jump on a call, we're not wasting time on what's a line of credit, how do I find one? Like, these are questions I've already answered. So I put them in order. That's what the manifesto program's for. $7 a month, you know, or you could pay $70 for the whole year. And I just create content. I'm basically answering your questions in videos, again, using scenarios all day long, every day. So Matthew, good to hear from you, man. I'd love to hear how you've been velocitizing your IBC policy. All right, if you want to comment your results, because I know you're using it for real estate investing, so I want to hear about that, and so that I can jump on board, because my next move is real estate investing. That's the next big play here. What's the next one?
Rochelle Ellis Smith, can you explain the credit card debt tool?
From earlier, right? Okay, yes, Rochelle. So the credit card debt tool that we had earlier, the reason why I took advantage of that is because he had a 0% offer on purchases, not balance transfers, or I think it was balance transfers, but in his case, just purchases. So all I'm doing is saying, all right, out of your income, Rochelle, let's say you were on the board, right? I'm using your numbers, and you had a 0% offer on a credit card, and you have a line of credit, the main thing, that's the one that we need, because we're gonna need something to, you know, wipe that out when we get to that point, especially if we're, you know, shifting all the expenses over to that card. And then at the same time, simultaneously, because I'm not paying those expenses out of the income that I make per month, that becomes cash flow, which I use to pay off another debt, right? And by the time I pay off that other debt, Rochelle, based on the numbers, I'm able to evaluate and see, okay, because I paid off that debt, saved thousands of dollars on interest over here, got a cash flow gain over there. Now I've got this big chunk of money, my line of credit. So by the time that credit card expires on the interest, I'll wipe that thing out, shift the debt back over here, and then all my income continues to go in there. It doesn't cost me any interest to keep flipping money around. That's all we're doing, Rochelle, all day long. I'm just, you know, flipping money here and there, here and there. All I'm doing is getting around the high interest costs of having debt. That's all we're doing, okay? So the credit card debt tool is just primarily for, in many cases, it could be temporarily used to pay off debt, like using it for like balance transfers. So you're just kind of shifting, you know, whether you got a 15% or a 20% debt, you just shift it to a 0%. You pay that little fee and simultaneously do velocity banking on other things maybe. And by the time we get to it, we wipe that thing out so we don't pay interest on that. Okay? Next question.
All right. Christopher Nolan, great job, Denzel. My question is, when you use the Chase card at 0% for a debt weapon, what percentage of usage should you use of the credit card limit? 30% is not good for credit score, correct?
Yeah, like when you go over 30%. I know what they say, but when we're doing velocity banking, your credit score is going to be going crazy, okay? It's going to be doing this. It's going to be going up more than it is going down, okay, when you're doing velocity banking. That's exactly how this really works when we're doing velocity banking. Now, I did say earlier that I only said go up to 50%. In reality, his expenses over the next 5 months that we shifted, when I was looking at it on the high end, we didn't even get close to 10K. We were more at like 8 or 7, okay? And that was about, let's see, from 20,000, what's 30% of a $20,000 credit card? I don't know my math here. Do I have a problem with my camera? Is it dead?
No, it's
Straight?
saying that top one is frozen.
It's frozen.
Click over to it.
All right. So yeah, $6,000. So in his case, the actual number was like $8,476. So $8,476 is what he's probably going to end up using for just that 5-month window. But understand that even though I'm increasing debt on one credit card with the utilization, we're also wiping out a ton of debt somewhere else. So the overall utilization is going to be going down, right? So that's kind of like how I did the math there for him. But in your case, I would just say, if you're going to use a credit card, in addition to your line of credit, your HELOC, when you're doing velocity banking, and you want to shift some debts over, I would keep it at 50% and under, or you can go right up to the 30% mark and leave it at that. If you're someone that has multiple credit cards, you got like 3 credit cards and they all got 0% offers, you go 30, 30, 30. That's fine. No big deal. You pay the minimums during the whole interest-free period. And then once you approach the expiration date, we want to make sure we wipe them out so that we don't accrue any interest at all. Okay? What's another question that we have? And then we'll probably wrap up in the next couple minutes or so.
All right.
Y'all like this board? Let me know. Comment below. You like the board?
Albert Ramirez.
My man.
How soon can I borrow from a cash value policy instant?
Day one. That's it. Day one. So I remember when I got my first policy, no, my second policy, I waited like a week before I borrowed money. But it's available. As soon as that thing is funded, it's there. It'll say you'll have an option to request a policy loan. I just tell my clients, let it sit, wait a week or two before we make a move. In reality, when I'm setting up these IBC policies, especially in your case, Albert, if we're going to be using it to, pay off your mortgage faster, what I'm doing is I'm pre-planning when I'm actually going to have the policy in place. So I try to have it funded, let's say a week or two before I actually want to use the thing. So in that week or two time period, all I'm doing is, helping you set up the account, log in, make sure everything is good, recheck, review the finances one more time before we borrow, making sure our numbers are right. So really that 1 week, 2 week period is really for me and the client to review everything that we just did up until that point, because we are starting something brand new. This is a new policy, new everything. So yeah, the money, not with all life insurance companies, is not with everyone. This is, to my knowledge, with the only 2 life insurance companies that I use, Mass Mutual and Guardians, the only 2 that I use, the only 2 that I have the money available first year, within that same year, and then every year thereafter. That's the next question. Is the camera working still or no? It's good now? Cool. Cool.
All right.
I'm glad I'm doing these test runs, man, because let me tell you, When it comes to the real thing, I'm gonna have me a nice stool. I'm gonna have, I'm gonna have things just, nice. Watch.
We're getting some new people. Danielle Simpson.
I know her.
What I am confused about is once we put our check into the HELOC and remove the expenses out of the HELOC, how do I determine when to remove the next chunk?
When to make the next chunk, Danielle, maybe? Or yeah, when to remove the next chunk, right? So we've got the checking account there. We've got your debt tool here. And we got the debt that you're tackling here. That's the primary goal, right? So however much available credit is on your debt tool, whether it's a personal line of credit or a HELOC, or maybe even a credit card, once we figured out what the chunk amount is, right? We hit the debt. The whole idea is I want to make sure there's savings on interest, first and foremost, each and every time. What are we saving? And does it beat debt snowball? We've got to make sure that it beats debt snowball every single time. Because if we don't, then it doesn't make sense to be flopping money around. Just pay the debt. You know what I mean? So does it beat debt snowball? That's the next thing you want to make sure. Okay. And what's the cash flow gain from that move? Once we get that solved, now you're in debt over here on the line of credit. And I know you understand this, Danielle. You dumped all your income in. Now you're taking money out to pay your bills, right? And you're wondering, okay, I'm putting money in, I'm taking money out, I'm putting money in, taking money out. When do I make my next chunk? When you hit zero, right? When you hit zero. Now, if you're someone that makes high income and you have high expenses, when I say high income, I'm talking to people that are 10, 15 plus K a month, right? And you have a line of credit that's relatively close to how much you make a month, right? So I have some clients like this, they make 15 grand a month and they have a $15,000 line of credit. So when you're doing velocity banking with a small line of credit, but you have high income, it might look a little funny. It's gonna look like you went to zero, but you still have to pay bills. So I did a video back in the day, I think like 2-3 months back, where I made a video. It's called, what if your line of credit is smaller than your income, okay? And here's what I did, Daniel. I came up with a month. I call it the independent month, okay? Hopefully I'm spelling independent right. Yeah, independent month, okay? Which determines whether or not I'm at a true zero balance on the line of credit, okay? So that's one way. There's another way to know when to make your next chunk, okay? Depending on what debt we're tackling. Let's say we made a chunk, Danielle, towards one of your debts, right? Let's say we made a chunk, but we didn't pay it off. We paid off maybe 50% of the debt or maybe 30% of the debt, whatever it is. So if I wiped out 50% of the debt, and let's say it takes you 6 to 9 months, because that's the time frame that I want to work with on each and every chunk, 6 to 9 months at max, and then at lightning speed, it's more like 3 to 4 months, okay, or like 4 to 6. Those are people with high cash flow where it's like they're going crazy, right? They're going fast. They're serious about paying off debt. Now, we have this one way, analyzing your independent month, recognizing when you're at a true zero balance on the line of credit, when you recoup, meaning I'm at zero balance on the line of credit and I don't have to use it to pay my bills. That's when you know you're at a true zero balance on your line of credit and you can make the next chunk. But if you're in a scenario where you are paying off a debt, let's say like a big student loan or a car payment, your first chunk, you wipe out 50%. 6 months goes by, you're still making the monthly payment. Maybe you only owe about 40% left on that specific debt. Well, in that case, I could just go ahead and make the next chunk on from the line of credit when I'm about anywhere from, I would say, like $1,000 to $2,000 left on the line of credit. So if you have something as little as if you have something as little as like a $5,000 debt to, or $10,000, I would just wait till you're at zero. But if you're someone in the neighborhood of like 50,000, 75,000, 100,000, right? You got a big HELOC, or you got a big line of credit, we don't necessarily have to wait to go to zero on that line of credit, because we could speed up in terms of how much more debt we're shifting to that line of credit. Because if I got a $50,000 personal line of credit, $100,000, and I only owe $5K on it, or $7K, that interest cost is nothing. So I don't mind coming up with my next chunk, which is going to be 2/3 of whatever I use. I don't mind. I don't mind, just making the next chunk, especially if my first chunk is more than my second towards whatever debt I'm wiping out. I might as well get it over with and not wait till I hit zero on the line of credit. So that's another option. So it's going to be one of the two. And like I always say, it depends on your 4 major numbers: income, expenses, debt, and the cash flow. Next question.
All right. John Trevino.
What's up, John?
He said, my friend doesn't understand why he needs the line of credit. He has $50K saved up and wants to use $10K out of it to be his own bank. What should I tell him, other than his money ain't working for him?
So in his case, what was the guy's name?
John Trevino.
John Trevino. How you doing, John? So, buddy has 50K initial capital. He said he wanted to use 10 to start the policy. What are you gonna do with 10K?
Yeah.
What are you gonna do with 10K? Get a massage? What am I gonna do with 10K? I would say you might as well shift the whole 50, and he could establish his own line of credit. Okay, so your friend is somewhat right. What do I need a line of credit for if I have a bunch of capital? I understand that. I work with people all the time that have initial capital already. Maybe they have cash. Maybe they got the 401k that they want to shift. Different assets that they're looking to shift. If that's the case, yeah, you could either send all of it or majority of it to the IBC, okay, or not, okay? The only argument that I would make in your favor, Jonathan, is if he's willing to go higher in terms of how much money he wants to put into this thing. Because based on his 4 major numbers, whatever he cash flows per year, plus the initial capital, and if I had a line of credit, I could drastically increase the IBC policy and have a much bigger line of credit. So let me give you an example so it sinks in for your buddy, okay? And this is a little more complex, but it's only if they're willing to like go higher. If he wants to be conservative and just throw 10K in a policy, I wouldn't personally do that with my own money. Like if I'm gonna do IBC, I'm typically kind of want to go like almost all in with it, or at least like have a good, you know, a nice something to work with. And if that's the case, and if he's got 50K in savings, he's not doing anything with it, and if he's not investing that money in real estate, then he's in a dilemma. You know what I mean? But let me just do like a quick example, my numbers, and kind of like how I'm, you know, determining what I'm gonna do here. So here's what I did to set up the IBC and basically keep all my cash flow in the process, right? So on average, so we got the income, expenses, right? And then cash flow on average, okay? I have, you know, a bunch of different credit cards. I've got one line of credit for 10K. What I did, instead of using my cash flow to pay for my policy monthly, right? What I did was I took from here, I took from credit cards. It didn't cost me anything. It was like a couple of dollars in terms of cost, right, to move a bunch of money. So I basically moved money from credit cards, from the line of credit. The total was $70,000 that I threw into the policy. This is what I cash flow monthly, right? So if I don't have initial capital to work with, then having a debt tool or a line of credit to help you initially fund it could make sense. All we got to do is the math on the dividend rate of what I'm earning over there versus what's it cost me to borrow over here, and to make sure that I've got enough initial money going in there to cover my new expense, because this is going to be a new expense that's going to affect your cash flow a little bit. So just a couple ideas there, Jonathan, just spitting some things out. I worked with this one guy that makes 35K a month. His cash flow is like 20, and he spends 15 grand a month, and he's got a lot of debt. But what he did, he didn't even pull from any of this. He didn't pull from the HELOC or any of his debt tools, because he had so much liquid cash on hand. He had about 200K, I believe. And what he did was he started 2 IBC policies, one on him, one on wife, right? So one on husband, on himself, one on wife. Each threw in 100K each. And then when it was all said and done, he had about 180K or less in cash value to work with. And what he did from there is he borrowed a big chunk of money from here and started to pay down his debt. His cash flow each and every month was getting dumped back into the policy, replenishing what he used, and he just kept creating a cycle. So he's doing velocity banking on the policy to pay off his mortgage. When I'm dealing with people like this, high income, high cash flow, good capital, sometimes we don't have to use a line of credit or a credit card or any such matter, because you already have the cash. Why borrow money and pay interest, right? So whenever I'm working with people, it's all about, can I borrow money without paying interest? That's all I'm trying to figure out. And then how fast can I pay off what I borrowed at 0%? And does it beat that snowball every single time? Let's go. I think, what are we at, an hour? Almost?
Yeah, 15 seconds left.
15 seconds from an hour. Nice, nice. You want to do one more question?
This person's name is One Snap Bean.
One snap bean. Whoa.
I have started VB, velocity banking, I'm assuming. I first had to drive my balance down on my HELOC.
Makes sense.
25K HELOC at 8.99%. I now have my balance back at 10K. Can I now send a 5K chunk at my debt?
Sure. Yeah, so let me write it out. So say it again
All right.
with the numbers. So he said he had a 25K HELOC.
25K HELOC at 8.99%.
Uh-huh.
And his balance is back to 10K.
10K owed.
Can he send a 5K chunk at my debt, at his debt?
First question I would ask him is, does it increase cash flow? If I make that move, right? Based on the velocity banking rules that I lay out for myself, 25,000 times 66% is 16,500. So he has about, you know, in terms of how much higher am I going to put myself in debt on the HELOC at that 8% rate, I would only extract another 6,500 max out. So he's right within the 5K. That's pretty cool. As long as this 5K is increasing my cash flow, I'm saving money on interest. Whatever interest I pay on the HELOC offsets, you know, whatever interest savings I had here, as long as there's an offsetting effect and there's a cash flow gain. Totally fine. I'm great. Let's do it. Let's make it happen. Let's keep the rhythm flowing in terms of, you know, keep paying off debt. I'm totally fine with that. That doesn't sound like a bad idea at all. Unless it just makes sense to pay that down to have a bigger chunk later on towards the debt. But you just run the math, you know, you just see, you know, does it make sense for me to, you know, if I only owe 5K on that debt that's left, you know, because let's say your previous chunk, what I was saying earlier, like you wipe out 50% of the debt or 70% of the debt with that first chunk, and then you only have to make like a little chunk left to wipe it out, and there's like a $500 cash flow gain from that. Oh, I'm jumping on that. I'm jumping on that, no doubt. But if it's only like a $100, like it was like a credit card or something like that, you know, we want to look at the math every single time. Okay, so I hope this was cool. You know, I'm still, you know, I'm getting comfortable with my spacing and feeling things out. You know what I'm saying? I want to hang out with you guys even longer and have people ask more questions. Join the Velocity Banking Masterclass. I will be starting it November 1st. That's going to be the first date, okay? I think that's a Friday. I forget. I think it's a Friday. The classes are typically going to be like, you know, early morning, afternoon, maybe late afternoon. I'm going to have different times. We're doing 18 classes or more. I'm going to have some bonus classes. You know, I might have some experts come in and give some more information as you're doing the concept and getting results. The whole idea is to just run scenario after scenario after scenario with each person that joins the masterclass. You get your numbers ran, you ask your questions, go. Do velocity banking, right? And you don't have to spend $3,000, $5,000 like most of the programs out there. On the average, if you're going to hire someone for velocity banking, it's quite expensive. So on this channel, we're just doing velocity banking. So there's not other things included like, you know, how to invest in real estate and how to 10x your income. So we're kind of like, I'm kind of extracting everything and just saying, okay, here's velocity banking. Here's how you can just start doing it right now, whether you're in the United States or maybe another country, maybe Australia, Canada, this stuff works. If you're in the UK, it's a little difficult. There are some options, but it is quite difficult to do velocity banking over there. Some countries, velocity banking does not work, but here in the United States, it works like a charm. All right. My name is Denzel, your personal finance geek. Hope you have a wonderful day and God bless.